affordable versus unaffordable markets. So we'll get into that. I'm going to, unfortunately, beat the dead horse of recession and trade war. Recession being a little bit of a question mark, but trade war being certainly evident. It keeps resurfacing. Is this just going to keep going on with 90-day pauses forever? But we're starting to see some consequences of it in Canada's economy. Okay, so let's get into it. Tomorrow's announcement, the expectation is that the Bank of Canada will hold rates. I would agree with that. And if you've been listening to my presentations for a while, that I was of the opinion prior that they would be cutting, but inflation situation on core especially has been sticky. And a lot of that is because of some of the issues that we're seeing on the trade side of things. So I'll go through that a little bit, but basically the easiest way to look at this is what the bond market's saying. You've got your 5-year Government of Canada bond yield relatively high. Long term, we're still in a low bond market environment, but short term, I would say we're high in comparison to where we were earlier this year when fixed rates were down. The reason this matters, I feel like I explain this on every call. We've got your Canada 5-year government bond yield higher than where we'd want it to be if we wanted to be in a decreasing rate environment. The bond yield is a decent forecasting measure for what the bond market is expecting long-term rates to be in Canada, given that this is a 5-year outlook on rates, because they're buying a government bond for a 5-year period. Fixed rates are based on government bonds because if I'm RBC, I can either buy government bonds, and therefore in doing that, I'm lending money to the Government of Canada and I'm getting a 3% rate, or I could lend money to Courtney and she's maybe slightly less creditworthy than the Government of Canada. So I would expect a little bit of a premium on that, usually 1 to 2% or 100 to 200 basis points. So this is where you'll often hear GOC plus 1 to 2, which is in your mortgage pricing. So fixed rates are often about 100 to 200 basis points higher than the Government of Canada bond yield. This is where we've got our fixed rate environment in the 4% range. It usually, again, will track your Canada 5-year bond yield with relative accuracy. The spread tends to increase in periods of risk and decrease in periods of less risk. The Bank of Canada recently looked at international trading flows and who owns the majority of it. And the largest portion of Canadian government bonds are owned by non-residents, foreign capital flows. And historically, it's been a lot lower. So we have a high degree of vulnerability to the global economy on that rate environment as well. Interesting part about this whole thing is that the bond market is typically wrong. The market is almost always wrong about what central banks will do. So you can see so it could be right now and then it's decided on its rate path, but then at some point in the future, something changes and the market ends up being wrong. You can see all of these lines here that show basically what the market thought rates were going to do. And then the red line is what rates ended up doing. The question that this chart ultimately asks is, why would the market be right about what the rate path is going to be today? In regards to foreign capital flows, I found that one thing was interesting. Canadians are spending less money on real estate, so we're buying less property. We know this as real estate professionals. The transaction volume has been significantly lower. Yet Canadians are spending more money on U.S. stocks. And I think that this is like that shiny object syndrome where the stock market is looking really sexy right now. We've got great returns. Everyone's piling into it. Retail capital inflows are the highest they've been in a long time. I think it's predictable that you would see a large flow of money. A lot of that money that's not being spent on real estate right now is going into equities, and not just the Canadian stock market, but the U.S. stock market. So just interesting thing to observe. A couple more things on debt trends. Statistics Canada put out a really interesting cross-section on which age brackets are seeing the most debt. And it's your 35 to 44-year-olds are the most indebted Canadians based on debt to income ratio. And this is from Statistics Canada. The same cross-section also analyzed wealth disparity, and Canada's income gap is the highest it's ever been. The rich are getting richer in Canada and the poor are getting poorer. A lot of this comes from wealth tied to real estate. The Canadians hold the majority of their wealth in real estate. This also tends to play a big role in what's happening between the rental market versus the ownership market. Your owners end up amassing more wealth, but if you have an affordability crisis or a housing crisis like we have in Canada, there's fewer and fewer transactions, right? Europe is a good example of this. If you go to Switzerland, Germany, the UK, et cetera, the number of transactions per capita is way lower than in Canada. Canada and the US buy and sell a lot of real estate because historically it's been relatively affordable by comparison to countries like those European nations. As we progress further into that realm of unaffordability like Europe, we end up being at risk of reduced transaction volume. Real estate professionals, Canada's larger, more unaffordable markets, and I'm going to get to what markets we're still seeing volume and what markets we're not. But in your unaffordable markets, so basically Vancouver, the lower mainland, let's call it, and the GTA or Greater Golden Horseshoe, real estate professionals are doing more and more leasing, less and less transactions. Could this spread as a phenomenon coast to coast? Probably, and we'll dive into that a little bit. Basically, rental tenure is going to become more and more common, which means home ownership will become less and less common. A lot of people are looking for a bull case for Canadian real estate, and I would say that this is it, right? It's not to say it's a good thing. This is a really bad outcome for a country, but the bull case for single family residential housing in Canada is that we're heading towards a renter's economy. Home ownership will become scarce. It's not just the real estate asset that will become scarce, but the ability to own a home is going to become increasingly scarce over time in Canada. CMHC put out their delinquency rates for all credit products. Everything's increasing, but you can see mortgage and HELOCs at the bottom there. Your two real estate secured lending categories are basically flat. Everything else is trending up. There's a handful of reasons why this could be the case. The big one is your house is typically the last mortgage you go delinquent on. You go delinquent on your car loan, your credit cards, your line of credits, and the house is the last thing you want to stop paying because you don't want to lose the house. The other piece is that our accountability environment has changed a little bit in Canada, where we have like this Canada Mortgage Charter, and basically banks have to do a lot to accommodate you if you're having a hard time paying a mortgage. And I think that plays a big role. If banks are more accommodating, that would mean that more people are getting accommodated, which would mean that you're seeing a lower delinquencies. The economic setup is such that we should see delinquencies be a lot higher than they are, and yet they're not. The question is why, and my answer would be that banks have more measures than they ever have to make it easy for people to not pay their loans, but like to help alleviate the pressure in people where people are in distress situations. Interesting thing about the way the consumers are choosing their mortgages right now, fixed rate mortgages are, so your 5-year fixed is historically the most popular mortgage product, right now the least popular mortgage product. We saw that big spike in people taking like your 3-year fixed, which is the red line here, and that's actually fallen off. People taking the 3-year fixed would have been communicating to the market that they felt rates would be lower in 3 years than when they were taking the mortgage, let's say a year or two ago. Now, consumers think that your mortgage payments, your interest rate will come down sooner than that. And they're doing that by taking a variable rate. So variable rate has usurped the 3-year fixed as the most popular mortgage types. Consumers are more and more taking variable mortgage rates to try and capture that downside potential in rates. It's interesting because most economists and the central bank are signaling that they think that rates will stay where they are or be in a higher for longer environment. I really think that the whole thing depends on the Fed and what happens in the US. And if they get some good inflation data and they start cutting, we've talked about that quite a few times. My thought is that rates will start coming down at some point in the future, but there's no data to push a central bank to make that decision anytime soon. I think we will start getting more bad economic data, which will likely increase the likelihood that central banks will cut. By the end of the year, it's likely we'll see at least one more cut into next year. Do I still think that we'll see another 100 basis points of cuts? Probably. Be careful what you wish for, because the economic indicators that necessitate 100 basis points more of cuts is usually not a good economy. All of this leads me to like this next research note that the Bank of Canada put out recently on their website. I would encourage you to just Google this title, and if you want to explore it, all the charts are interactive that I'm about to show you. This is the Bank of Canada showing the bond market, and so your 5-year and 2-year Government of Canada bonds, as well as the policy interest rate, believes the rate path is going to be like, and this would really allude to that sort of higher for longer situation. Even with that outlook, they have about 1/3 of people renewing with an increase to their payment. So I know that there was a lot of headlines that came out like as many as 60% of people could see increases in their payments, but the likely outcome modeled by the Bank of Canada is that about 1/3 will see increases in their payments. So you've got two charts here. The one on the left is mortgages with payment increases, and it just basically lists the ones that have. So there's no variable rate on this because variable rates have already seen their payment increases. You've got your fixed payment variables when they're resetting into the new rate environment. There's a very small portion of the total mortgage basket, but they'll see their rates increase. In the blue on the left-hand chart, you've got your fixed rate 3-year fixed, the blue, or 3 or 4, 2, 3 or 4. And then your yellow, which was all of your 5-year fixed people who took mortgages in 21 who are coming up for renewal in 26. 2020 is coming up for renewal on your 5-year fixed products. They will see an increase in mortgage rates because rates were super low in 2020 and 2021. On the right-hand side, mortgages with payment decreases. So we're at the point where about as many people will see decreases in payments or no change in payments as we'll see an increase. And a lot of that's your shorter-term fixed mortgages. So a lot of those 3-year fixed people where we saw that big hump and they made the right decision on the rate. I have one of those renewing in October. My rate will be probably 150 basis points lower than it was. I think I was at like a 5.4 3 years ago, halfway through 2022, I guess, or end of 2022. And so end of 2025, that'll come down. I'll probably renew that in the low 4s, I'm hoping. Then you have your fixed payment variable. There's a portion of them that had their rates set at a point where they'll actually see their rates come down on renewal. And then your entire variable rate people, because they already saw their rates increase, they're either heading into a variable rate environment where rates have come down, or they're going to be renewing into a fixed where they can capture a lower. Could be another reason. I don't know if it's fair to cast that on the entire mortgage holders, to assume that all mortgage holders are all the fact that the majority of mortgage holders are variable are taking the mortgage for that reason is probably a big assumption or a big generalization to make. Would it be likely that many people would be choosing variable for that reason? Typically, your variables have a smaller penalty than a fixed rate mortgage and would give you a greater degree of liquidity or flexibility to sell a property. Definitely a reason why some people are choosing the variable rate, but I don't think you can say the entire market for sure. If the entire market was doing that, then we would see 30% of properties going up for sale in the next year, which would be a catastrophe. It'll never be gone with the wind per se. I just think that we'll get to a point, we'll look a lot like Europe. Right now, Canada's homeownership rate is 66%. So 2/3 of Canadians own homes. I think that we'll get closer to like a Germany. The UK is lower than us, but they're in the high 50s, I think, or low 60s. Germany would be like one of the lowest. Switzerland is also pretty low. I think it's pretty easy to see that from a policy perspective, Canada is heading in that direction. But if you go back and look at what happened in a lot of those economies, the infrastructure of switching from a ownership to rental economy it doesn't just happen overnight. You need to build a lot of rental housing. And that's what we're doing right now. This will take decades, a 10-year trend at a minimum to get to like 50 whatever percent. You can see Canadian homeownership rate falling. Like we came from 69% to 66%. That'll continue to fall as we build more rental than ownership tenure, right? That's just how it's going to be. And you can see that happening now as a result of CMHC's MLI Select program and favorable terms for investors to create housing, more favorable terms for investors to create housing than for ownership housing to be created. I would say it'll never be gone with the wind. For us to get to a homeownership rate in the 50s, you're probably 15 years, to be honest. Any other questions there before I move on? All of the things that I mentioned before there, to summarize that, the Bank of Canada has basically these two charts. So by the end of 2025, they have 70% of people not seeing a change in payments. When people say like the majority of mortgages will see higher rate, actually the majority won't see any change. You'll see about 10% see their payments decrease and about 18%, just shy of 20%, let's say 20% increase, 10% decrease, and the remainder, no change in payment. By the end of 2026, and this is including both years, the number of people who see their payment decrease jumps up to almost 25%. So almost a quarter of people will see their payments decrease. Less than half will see no change in payments. About a third will see an increase in payments. So when we say about 1/3 of all mortgage holders are likely to see payment increases by the end of 2026, this is the Bank of Canada data that's substantiating that. Yeah, I could see it getting into the 50% range. I don't think we'll get to 50%. Eventually, probably we will. But like I would say in a 15-year outlook, we'll get into the 50% range. So you'll get below that 60%. I think you drop like 1% per year for 10 years. It still takes us 10 years to get to high 50s. It's never a straight line like that. Like it's always up and down. If you go look at it on the past 20 years, like some years it's higher, some years it's lower. Unless we see some change from a policy perspective, the writing is on the wall. We're building way more rental now than we are homeownership. Even if you account for the condo boom or all the subdivisions being built, a lot of those end up as rental tenure as well. A lot of investors buying up those condo units, that's how they get funded. I don't say 50% per se, but into the 50% range. As soon as your homeownership rate starts with a 5, once you're in that 50% range, that's really progressing towards a renter's economy. If you actually want to be in a renter's economy, you'd have to have more renters than owners. Do I see that happening in my lifetime? Yes. Do I see it happening in the predictable future? Probably not. If policy continues the way that it is, it could happen a lot faster. I think eventually you'll start seeing pushback. I think you'll see a lot of baby boomers in a 20-year period start selling houses. Now, all of a sudden, you get this redistribution of wealth. You get more wealth put into the hands of the younger people. That younger people have had more time to accumulate wealth. And so that can push back against our progression towards a renter's economy. Yeah, so typically your European housing model, there's very little transaction. Like people don't really use homes as climbing the housing ladder. When I'm talking about a European housing model, I'm really talking about more the Western European housing model. A lot of Eastern European models have, like especially the post-Soviet states, have the I guess socialist or communist influence or former communist states, and so a lot of them actually ended up handing assets. So they have really high homeownership rates, right? They have some of the highest homeownership rates in the world. In Romania, in Western Europe, it's a little different where you see lower homeownership rates. In those markets, homeownership is very much a multi-generational thing. Canada, the US, and Australia are a couple of the countries that still haven't adopted this, but multi-generational living is very common around the world. It's not to say whether or not I think it's the right way to do things, but everyone else has done it in some form. And so in Europe, people, in a lot of cases, like you'll speak to people in their families for 100 years, right? It's just been passed down generation to generation. And a lot of young people, when they go to start their career and work and live in an urban area, they rent. And then when they move back out to the suburbs, they're taking over the family home or whatever. And there's easier ways to stratify houses. You could split up houses into multiple units. If you go look at houses in Italy or France, it's not uncommon to buy a unit within a small house. People own their houses longer in Western Europe and Eastern Europe as well. They own their houses longer. We don't have this idea of constantly trading up houses and almost like a housing Ponzi scheme or this wealth creation ladder like we have in Canada. Any other questions? TD did an analysis of what's happening with rates and mortgage payments. The conclusion that they came up with is that Canada's aggregate mortgage payments are trending lower. So if you add all of the mortgage payments of all of the Canadians together, they're trending down by comparison to what we expected. This mortgage renewal wall that we hear a lot about has been softened. Before it was like you weren't going to be able to get through it. Now it's like you should be able to drive through it. You probably still, maybe your bumper will fall off or you'll damage the front end of your car, but we can actually make it through. So it's going to suck, but it's going to suck a lot less than we originally anticipated. The next piece is they tied this to that wealth disparity thing that we were seeing, where basically debt and leverage, the way they measure it here is your debt to disposable income ratio by income quintile. Your lowest income quintile is, so the poorest people are seeing the most household indebtedness. So again, the SAC did it by age, the TD did it by income bracket. All of this is to say that we've seen a lot of wealth creation happen as a result of real estate, and there's a further and further encoded disparity that's happening between asset owners and non-asset owners. And this is all things that kind of lead me to believe that we will continue down the path of decreased ownership, the separation of classes between owners and non-owners, which is not a good political or policy outcome, but it is the way things are going. Interestingly, if you look at the way that people are piling on debt right now, older people are actually seeing the largest percentage increase in indebtedness among anyone. And people younger than 35 are actually the only group seeing a decreasing amount of indebtedness. The biggest reason for that is we basically can't afford to buy houses anymore, so we stop buying them. Our mortgage indebtedness as a group of people under 35 just stopped growing at that point. But you started to see all the other groups of people increasing their average mortgage debt by age group. Your 45 to 55, the red line here has been increasing. Your 35 to 45 has been increasing, but slower. And then basically 55 plus has actually been seeing the biggest increase and the fastest increase in the amount of debt they're piling on. A big reason for that is a lot of these people are co-signing on mortgages for their kids or taking out HELOCs to help fund mortgages for their kids. Homeownership is so out of reach that you need parental support or multi-generational savings to achieve it. It's a chicken and egg question. Right now, we're seeing rents falling. If rents are falling, it's basic economics. If things get cheaper, people are more likely to consume it. If rents fall, that'll expedite the rate at which we progress towards more people renting than owning, because renting becomes more financially feasible than owning. And so if rents come down, we will see it, provided that, again, the easy way to answer the question is it really depends on supply and demand. But if we are progressing towards a renter's economy, if we still have policy designed to make it easy for builders to build rental, then rents will probably not climb per se, because we're building enough rental to make it affordable for people to move towards that rental model. Eventually, when we stop building that, or if rents stop growing, which they have, and you're already actually seeing this, Mike Moffat just put out a chart on it, but CMHC actually modeled out into 2027 that they expect housing starts to decrease pretty substantially. Housing starts at a record. They're up 14% year over year for June. We're seeing a lot of construction right now, but builders modeling forward and saying, if rents keep falling, or if rents fall another 10% by this time next year, why would I build this thing? I'd just rather wait. And so you get your supply, prices come down, prices are down, so nobody wants to hit supply, and it oscillates. I would say that if we progress towards a renter's economy, it typically means, and if you look at what's happening in a lot of these European countries, it's not nearly as expensive as a percentage of household income to rent a property in most of these countries as it is in Canada. And so if we are going to progress towards that, we need renting to be cheaper, and it needs to be more financially sensible for people to rent and then save their money than it is for them to own a home. Because a lot of people are making that decision, do I want to pay the extra? Because it does cost more on a monthly basis to own a house. Do I want to pay the extra and have that going into principal and saving my money for me and investing in that hard asset? Or am I good enough at saving and investing on my own that I want to make the decision to rent? Not everybody gets that decision, because some people do it out of necessity, but when you're boiling down the comparison of incentives, that's the way to think about it. I saw a follow-up there, tapping into the same questions with all big banks, changing policy from 4 days a week from the office starting in fall. What does that mean in terms of demand for major cities, downtown Toronto specifically? Can Valerie generate that? There is a good chart. We've been seeing a clear reurbanization of demand for a while, even before return to office was mandated to the level that you're describing. If you look at the most recent Market Watch reports, you can see urban areas are doing a lot better. So prices have been a lot more sticky. They're down still, but 905 as an example is down way further than the 416. And so you're seeing more demand propping up prices in your 416 than the 905. A lot of this could be the urbanization that we're seeing. You got fourplex policy, sixplex policy happening in the 416 area. That could play a role, but the bigger piece is probably that your end users are actually starting to, the dream that we could all live in cottages. You go look at the 705, right? Muskoka, the prices are way down there. The severity of price decreases is worse the further you get from the core, because that idea that we could all work remotely and live far away from the city and take a train in once a week appears to be diminishing pretty quickly. And so we are seeing a reurbanization of demand. I could probably chart prices in like Muskoka or even just 905, 416, then it would probably illustrate that reality. Core has definitely been stronger. You see this across the country, except for Ottawa, because their return to work hasn't really been as mandated, although it's starting. Government workers have their return to office 3 days a week, whereas we're seeing banks and companies headquartered in Toronto going to 4 and even 5. Ryan Dehaney, our REITs, pension funds, investors moving out of Canada. Could this create a monopoly in the multifamily space? Unlikely. I think rental ownership model is already so vast that there's enough capital. Even if you look at CMHC MLI Select, there's tons and tons of small projects being funded, and a lot of people can only get 1 to 2 of those, right? And so they're doing them, but that creates hundreds, if not thousands of owners. Will we see an oligopoly? Yeah, maybe. We already have that. You have a handful of very large Canadian landlords. Could we see an extreme concentration? No, probably not. And to be fair, you might not necessarily want that. If you look at what happened in Germany, they did a referendum to take all of those units away from private ownership and have them state-owned, which is not necessarily a win for the unalienable property rights as we hear about them in Canada, which is one of the big reasons why people, especially libertarian-minded people, want to own property rights. Let's jump to this next chart here. Same kind of concept here from TD. Mortgage service costs have settled. They're at a much higher level than they were before, but we're not off that volatility. You saw that huge spike up earlier, and now we've gotten away from that scary volatility. You saw a little bit of a drop. If I'm modeling my investment decisions, I'd be modeling, can I survive a 4% rate environment for 10 years? I think a lot of people are ambitious to underwrite to the downside on the rate side of things or upside on the price side of things. If your deal depends on rates decreasing or prices increasing, I think that that's a kind of thing where you do really might want to rethink that deal. The consequence of this indebtedness where we're at is household debt per capita. Canada, our household indebtedness is converted to USD. Our household indebtedness is significantly higher than a country like the US. And so we wonder, why is Canada having such a hard time growing? A lot of people blame the government, and I'm among those people. I love blaming the government for stuff, but we also have individual accountability that we need to own. Canada is the most indebted economy in the world on an individual basis. At a national level, our government is actually upper middle, but we're not the worst. The US is the worst, but that's government debt to GDP. Individuals, debt to disposable income, household debt, far worse. And you would say, oh, maybe income is not the right way to look at this. Should we look at liabilities to net worth, maybe as an example, because Canadians have a higher net worth than Americans because we owned this real estate and because our real estate values went up? The answer is still no. We're still worse. We still have a higher liability relative to our net worth than Americans. All of this to say that the Canadian economy, I've said this a couple of times on these calls, but people ask me what's the catalyst for economic growth in Canada. The reality is it comes from us as the consumers. The government can do stuff. They can make policy better, encourage more business, spend more money on research and development. They can spend more money on infrastructure. They can reduce taxes. There's so many different levers that they can pull. But those are uncontrollable factors. The controllable factor is how much debt we have. Canadian household indebtedness, Canadians are deleveraging, right? So we are reducing our debt exposure as it stands right now. This is going to continue, and it has to. And the reason is because, unfortunately, Canada built an economy around credit. A lot of other places in the world, people don't buy things if they don't have the money. We're not like that. We buy stuff that we don't have the money to buy, and we assume that we're going to spend the rest of our life paying for it. This is our version of capitalism where we think that our ability to pay it back in the future will be better. And so we're happy to absorb that interest burden between now and the future because we want the things now. We want the nice house. We want the leased BMW. We want all the whatever, right? Like we suck at deferring gratification as a society in Canada. That is something we need to get away from if we want to grow. Canadians individually need to be able to spend more money if our economy is going to grow. And you cannot do that if we have too much debt, because now we're at a point where we're in a new credit cycle at new interest rates. We could pile on more debt during COVID when our debt level dropped because everybody was getting helicopter money, stimmy checks. They didn't have to pay their mortgages, right? There was all these reasons our household indebtedness actually dropped. And what happened? The economy ripped because we could spend again, right? Because our debt level was lower. Interest rates were lower, and that made it easier to take on more debt to spend more money to grow the economy. We don't have that luxury anymore. So the only way for us to actually have more money to spend in the economy to grow the economy is to reduce our debt. How do we do that? We're seeing it right now in the real estate market. People are selling properties. Where's the biggest concentration of household debt in Canada? Mortgage. People are selling properties, getting rid of frivolous expenses, paying off their credit cards, selling stocks, pay off whatever. That's what deleveraging looks like. The Canadian economy needs to deleverage to grow. Deleveraging is not a pretty process. That would be a recessionary activity, a deflationary activity. It has to get worse before it gets better. Even if the Bank of Canada dropped interest rates to 25 basis points, we would still only be able to go to that ceiling we saw. And we're not that far off that ceiling. Debt is total household debt, how much money you owe, all things combined. Disposable income is money left after taxes and basic necessities. So you take the debt and divide it by the disposable income. We have the highest debt to disposable income in the world. House prices now, I'm definitely behind, so I'll try and rip through these pretty quickly. House price momentum, not trending in a positive direction. I mentioned a long time ago that after the big drop, if you look at the 1990s, market traded sideways for a long period of time. I would expect that to continue. Even when we get to recovery, it will be a very slow recovery. So somebody mentioned there's also positive debt like a mortgage, since you can reclaim your investment and it adds to your ROI. Yes and no. It's a double-edged sword, right? You could also argue that leverage cut's great on the way to improve your ROI on the way up, but if somebody's house is going down in value or the cash flow negative, then their losses are also amplified, right, by the leverage position. If you have very little cash in, but if you only put 10K into the property, let's say you're 95 LTV, first-time home buyer, and your property goes down 10K in value, you just lost 100% of your investment. If it goes up 10% in value, you just made 100% of your investment. So it amplifies returns to the positive and the negative. I agree with what you're saying, but I would also say that it's worth noting that the same is true to the downside. A lot of people dismiss that reality that debt cuts both ways. I'll jump over house price history because it's just a reiteration of what I just mentioned, but basically sideways market. Resale inventory, not necessarily piling up like we're hearing. This is at a national level. It is in some markets. I'll go through which markets are in buyers versus sellers territory, but we're still not even back into a historically balanced market territory where you've got inventory in the 4 to 6 months of supply range. I would say a lot of other markets outside of the lower mainland, Toronto or the GTA or Southern Ontario, skewing in a positive direction. Ontario and BC are skewing in a negative direction. And so at a national level, we look relatively balanced. Sales to new listings ratio, again, still in that balanced market territory, sort of dead in the middle. This is a good market, by the way. This is what you want to see. You want to see a market where the market is balanced. People can take time to transact. They can get conditional offers in. They can do home inspections. They can ask their lender to appraise and finance the property properly. This is a good outcome. As real estate professionals, we want this to be taking place, right? This is a good market for us to do a good job, to represent our clients well. The next thing I'm going to look at here is market balance by region. The only markets where we're seeing buyer's market territory is Ontario, and not even all of Ontario, like basically Toronto, Barrie, and then your lower mainland. So basically Vancouver area. The rest of Ontario is more balanced, the rest of Ontario and BC is more balanced, a little bit more favorable to buyers in most markets, but Victoria still favorable to sellers. Calgary slipped into balanced market territory, but still slightly in favor of sellers. I would say if you want to understand that, the balanced market territory is between the green and red line here. If you're to draw a line at 50%, so in the middle of those two lines, anything above that is slightly more favorable to sellers. Anything below it is slightly more favorable to buyers. This is your sales to new listings ratio. So basically take the number of properties that sold last month and divide it by the number of properties listed last month. Whatever percentage you get, that's the metric. Everywhere outside of Ontario and BC, all in markets that favor sellers, many of them in sellers markets. Why is this the case? The reason for this is because those are markets where people can afford to buy houses. And so people are still buying houses. If people can afford to buy something and they want to buy that thing, they will buy the thing. And so in Ontario and BC, people still can't afford to buy houses. Prices are still way too inflated. Not to say that they're going to come down significantly more, but the way that we buy houses, we use mortgages. There's 3 levers in that equation that can change the way that somebody can afford a house. One is wages. Wages need to go up. Probably not super likely heading into recession with rising unemployment. We might see some wage growth, but it's not going to be outsized. Number two is interest rates need to come down. Do I think that'll happen? Probably we'll see cheaper rates sometimes over the next 365 days. The last one is house prices. Could house prices come down? They might have to, right? If we need more affordable houses, the cure for high prices is high prices, right? If prices are too high, people stop buying it, prices have to come down. The market might take more time to adjust, but this is why we're not seeing tons of transactions in the Ontario markets, because there isn't a huge group of people who can afford to buy houses at this price. See a comment in the chat there. Due to the new CMHC rules raising the insured mortgage cap to 1.5 mil, the homes in the 1 to 1.5 mil range see the greatest appreciation. Probably not. The buyer who's using CMHC to buy a house, there's such a limited number of those people who can qualify for anything higher than like that increase was more for upsizers than it was for your kind of like first time buyers who are buying with that high loan to value mortgage. Yes, it was basically just a policy for Vancouver and Toronto, where first time home buyers are high earners, maybe $250,000 household income. That's what you need to qualify for 95% or whatever, 87% mortgage over $1 million or whatever it is, right? So it's not just purely policy, it's also underwriting. Their income is the biggest prohibitive factor in people being able to use those mortgages. I presented this on one of these calls 6 months ago, or maybe even longer. It was towards the end of last year. TD modeled out exactly what you're describing, Ryan, which is that would front load all of the gains that would have happened as a result of that policy almost instantly. They expected it to happen within the first quarter of last year. And yet prices fell in the first quarter of last year. Why is this? The reason is other things are more powerful than having more debt. The job market was more powerful. Tariffs were more powerful. Trade war, all of these economic factors, the fact that we're in an election overpowered the positive impact. Do I think those will see the greatest appreciation? Probably not. I think your entry-level product is where you're going to see the strongest appreciation, just because relative to the remainder of the market, every dollar that's added to people's wages, the buying power gets stretched the furthest because those are lower value. So any dollar that I have, if I amplify that as buying power, I can pay the magnitude of the increase of price that I can pay for a $600,000 property is much higher than it is for $1 million property. If a renter could afford to buy, would I recommend proceeding to buy or continuing to rent in the GTA? If you recommend buying, what's the best to buy, condo, townhome, detached? There's really no one size fits all answer to this question. This is an exercise that somebody just has to run the numbers on their own. What's my cost of renting? How much money can I save on top of that? So let's take two properties side by side. You can probably find this because there's so many properties on the market right now. So you go look at a condo. How much would it cost me to own this condo? Okay, I'm going to have to put $100,000 down. What return could I get on that reasonably? Am I a good investor? Am I actually going to save that money or blow it on a Lambo? If I save the money, what am I going to get 10% per year or the S&P average, or what am I going to get put in dividend stocks and get 5%, whatever? Actually run the cost benefit analysis. Punch this into you can even type it into ChatGPT now. Give me a cost benefit analysis on renting this unit for $2,000 or owning this unit for $3,000 a month plus a $100,000 down payment. For some people who are good at saving money and good at investing, it always makes way more sense for them to continue renting. The truth is, most Canadians suck at saving money, as we saw on the debt to disposable income chart, right? We are the worst at saving money and the best at piling on debt in the world. And so and I fall into this category, so I'm saying it with empathy, not with judgment. I want to buy a house because I have kids and my money just disappears. If I want to accumulate wealth and save money, a mortgage is a really good tool for me to do that. When I was single and I didn't have to spend a lot of money on house, kids, blah, 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 all this stuff, I could save a lot of money. I could invest it really well because I had the time and the freedom and to try and put my money into that. It's just purely a cost benefit exercise. In a lot of cases, good investors can easily beat homeownership. Most people aren't good investors. Most people aren't good savers. That's why Canadians love homeownership. Okay, sorry. I'm going to try and burn through all these real quick here. This one I think is important to think about. First-time home buyers basically get a 40%, or sorry, $40,000 or $50,000 advantage. It's a government subsidy. It literally is tax subsidized. So they get HST removed if they buy a brand new house. And that ends at homes priced over $1 million. I would say that we're going to see a lot more builders trying to build houses under $1 million. This could be condos, this could be townhouses in 905, et cetera. The reason is they're going to try and capture this. Builders probably can't necessarily charge that entire gap, but let's say builders get 20K of that gap. The buyers get a 20K discount. It's like a subsidy because they're not paying the GST. It's a win-win for everybody except the government, but they don't need more money, so whatever. And so this is a trend that I think is really important for people to look at. If you have first-time home buyers, I would be strongly encouraging them to at least start the process of looking for opportunities in the new build space. The reason being, like, we haven't had a setup like this since the 90s where you can negotiate with builders, maybe not on price per se, because they are negotiating on price, but they're doing it in a way that it doesn't really show up in the market. But you can get concessions on closing, you can get tons of upgrades, all of these things. If they've already decided that they want to enter the market, again, it's not up to me to tell somebody whether or not it's a good time to time the market per se. But if they've made a decision that they want to enter the market, there are a lot of good opportunities, new construction market for first-time home buyers in comparison to the resale market right now. And so this is something I would very much be encouraging people. If builders and first-time home buyers, if you can figure out a way to do deals between the two, this is one of the best opportunities in the country right now. Not to say that new homes are priced appropriately, but if that's what people are looking for, I think there's a good opportunity. The policy outcome will be very evident in a year's time. Where this is most concentrated is in Toronto and Vancouver. In Toronto, it would reduce the mortgage payment for a first-time home buyer by almost $250, and it would reduce their down payment by almost $10,000. Vancouver, slightly less than that, and then you can see the remainder of the cities. Even in Calgary, your mortgage payment's going to go down by $150 a month compared to what you would have paid. This is just from the HST being rebated. Pivoting more into the rental side of things, we're building a lot more rental than we are homeownership now. So your rental apartments is the light green line here. This is from Desjardins. They didn't really choose exceptionally clear line, but I have a better chart from BMO here. This was in Better Dwelling recently, but basically your rental starts going up big and your condo starts going down big. This is like the clearest illustration of how we're progressing towards a renter's economy. We're building way more rental than ownership housing right now. If you're an investor, you should be modeling huge increases in the vacancy rate and decreases in rents moving forward, because you're going to be competing with tons of massive professional landlords over the next several years. This is more concentrated in certain markets than others. Now, so in Ontario, where you would think that it's going to be the worst. In Ontario, CMHC MLI Select doesn't actually get a ton of housing built because the economics of it don't work exceptionally well here. So Ontario, we're not seeing a ton of purpose-built rental housing starts. We're seeing massive amounts of purpose-built rental housing starts in BC, where literally, this is a crazy stat, over 14% of units are under construction right now. If BC's population doesn't grow, new household formation doesn't increase, and people aren't leaving their parents' basements to go rent new units, BC's vacancy rate would go up. That's an oversimplification. That's not going to happen. But these are huge upward risks to vacancy. Atlantic Canada, just as bad, right? 12% of their entire rental supply is under construction right now. Alberta, over 8%. These are things that you need to be underwriting if you're considering making real estate investments in these markets. These are all going to make rents fall, make vacancy rates rise. To look at this another way, the ratio of rental housing starts to condo starts is the highest it's ever been and climbing at a very fast rate. What does this mean? This comes from the Habistat. If you're a member of the Toronto Real Estate Board, go to the habistat.com. You have access to this. The most leasing volume we've ever seen. Even though the market is really bad, we're seeing more leases taking place than we've ever seen. And it's way above the last couple of years. So if we keep seeing more leasing, this means that we're heading towards this renter's economy that I've been describing. A couple of cool charts here from a buddy of mine, Rob, who's at my brokerage. And this is all GTA, but we're seeing resale months of inventory higher, seem to have settled into this channel of above 5 months, would be comparative to like your kind of historic, normal, balanced markets, right? Definitely a market that favors buyers. Number of sales trending down, so we're not seeing an increase in sales in the GTA. The number of active listings seems to have settled into a higher channel. We did hit a record high a couple of weeks ago. Rob does these on a weekly basis. I would encourage you to, if you follow him or if you're on any social media, look up Rob Merciglio. He puts out really good stuff on the Toronto micro. The active rental listings seem to have settled into this higher channel. You do see these weekly fluctuations, but significantly higher than historic. Power of sale as a percentage of total. Power of sales, they still are very high, but we're seeing so many other listings that as a percentage of total, they're actually shrinking. Active listings on PropTX boards, again, hit an all-time high recently. Number of active listings you can see here. That's the same chart as the one before. This is about 10% higher than any other year. This is another great chart that really indicates how we're progressing from homeownership, from a policy perspective, from homeownership more towards rental. CMHC now insures a higher dollar volume of rentals than owner-occupied units. CMHC insures units. They insure for homeowners through owner-occupied. So if you go buy a house, you want to buy with less than 80%, if you want to buy with less than 20% down, CMHC provides the insurance. With rentals, they do something called MLI Select, as well as a couple other programs. They've just crossed the threshold where they're now insuring a higher dollar volume of rentals than ownership. And so even from a policy perspective, it's visible that we're trending towards a renter's economy. I want to cover. Actually, the next chart, this is a good example of what happened. So Calgary went through what I was mentioning where they saw an oversupply or over construction. In Calgary, you're brand new. Just look at the bars on the right-hand side of the screen here. New houses, so anything built after 2015, your brand new apartments, sorry. They were trending at a 2% vacancy in 2023, which is blue bar in the middle. By 2024, that vacancy rate jumped up to 7%. Cast that out over all those other markets that I mentioned and think about what could happen to the vacancy rate in those areas. This is probably a decent indication of why we're seeing rent growth changing. Population growth is basically zeroed out. Do I think that we're going to see 0% population growth for the foreseeable future? Probably not. I would imagine it'll probably be above zero next year. But like a year ago, when I saw that I saw rents starting to fall. I guess it was not a year ago, but like 6-7 months ago, I saw rents starting to fall. I was consulting for a developer in Toronto, and I mentioned to them, I said, I'm willing to bet that population growth is falling. You just can't see it in the data yet because rents are falling, and they are super correlated. So why are rents falling right now? Because population growth is falling. The rest of the stuff is really on tariffs, and I honestly do feel like I've beat a dead horse on that one. So far, tariffs haven't added a ton to inflation. They've added a little bit, but not a ton. The Bank of Canada is concerned that there are potential pass-throughs to consumer prices, and their upper bound would be pretty scary. The biggest areas where there's risk is in food, which you can see on the right-hand side of this chart here. This is all on the Bank of Canada's website. If you search tariff pass-through Bank of Canada, and durable goods, you can see like the way the range is. So durable goods is like your stoves, fridges, stuff like that. You can see the range is not massive, so they almost fully expect these tariffs to basically completely pass through to consumers. As real estate professionals, where we often interact with fridges, stoves, etc., this is an important thing for us to know. I'll leave you with that. If anybody has any questions, I know we're over time here. I'll try and blow through them quickly, but I'm happy to answer any questions.